Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. So hello, everyone. Welcome to the Greater Central Florida Multifamily Investors Group meeting, where we focus on investing where it makes sense. I'm your host, Ismael Reyes, and the goal of this group is to learn from and help each other do multifamily deals with a focus on Greater Central Florida assets or potential partners. Tonight, we're going to talk about the federal fund rate increases and their impact on multifamily investments. The rising interest rates, which began with a 25 basis point hike by the Fed in March, continued with a 50 basis point increase last month. And last week, it was bumped another 75 basis points, the largest single bump since 1984. And it's already resulted in a shift in behavior due to a concern about where rates are going to land in the next 12 months. So if I had a sound effects on this show, I'd have haunted house creepy sounds right now, because it sounds really scary, right? But not so much. Let's take a look at the data. I've got a little presentation or just a couple slides that I just want to show that I think will kind of put things in perspective, and it'll be good to frame the discussion as we go forward. So let me share my screen here. All right, can you guys see that?
Yep.
All right, good. So here's the first one, right? We talked a little bit about the federal funds rate, effective rate, not the seasonal rate. And what I did is I just basically pulled up a chart that really shows a bigger trend, right? The bigger historical trend to put things, like I mentioned, in perspective. And so what you see is, if you look at right now, even with the 0.75 bump, 75 basis bump that we just had, we're at 1.58 interest rate. And somebody correct me if I'm wrong, but I'm pretty sure that's it. And if you look where we were, even in the recent past, right? We're talking, what is that, about 2017 or so, or 18, we were actually higher than we are right now on the Fed funds rate. It just feels bad because we've been so low for so long. You know, we've been printing money and everything's been kind of at a steady, almost a zero interest rate kind of place, that it feels like, you know, we're going to hit doom zone here. But look at where we were, you know, historically. We were on the 20% and higher in 1980s. And if you see these little gray graphs or the bars, those are actual recessionary periods that we've had. It's just give you an indication, right? So I just think that, you know, it's good to see it. And yes, there's an impact, but I don't think it's a long-term impact. Here is the impact. And this is what it's got, obviously, the Fed doing what it's doing now. If you guys that listened to this show even 12 months ago, or maybe a little bit less than that, you know, we talked about the fact that inflation was not going to go away. And then everybody was saying, yeah, it's going to go away. It's you know, as soon as COVID kind of took that first downturn, everything was going to go back to normal. And a lot of us, just by looking at the data and looking at, you know, just supply and demand, basic fundamentals, we knew that it was not going to be that way, that we were going to kind of be in this, you know, inflationary period for a long term. And kind of that's where we're at. And so if you look at it here, where we are right now, it's actually the highest it's been from an inflationary standpoint, you know, well past into the 1980s. So it is a very high inflationary period. We do expect that the Fed's going to continue to bump, but they have to be careful because they don't want to go in, they don't want to push the country into a recession or a long recession. You know, you can have a short recession and that's fine. That's a regular cycle, but anything long-term, and I think that'll be more detrimental, and they'll put the brakes on any kind of Fed fund increases if it becomes that way. So I just wanted to put that into perspective for everyone, because it does feel like, you know, the end of the world, and we're really not. It's actually a very good time. You just have to have different strategies as you go into these acquisitions. So I think that's, let me stop sharing here. I think that's all I wanted to kind of go over. And I don't want to steal the show from Russell, because Russell's gonna, you know, this is kind of set in the background, but Russell Nova, who's the guest here, and I'll give him a formal introduction in a second. He's going to talk about some of the things he's seeing right now from operators and from lenders, and how we can kind of work in this environment where we do expect to see some additional rate increases, but again, just things that we just have to account for in the business. What I'll do now is I'll give Russell a good intro. He's got a ton of experience. Not only is he a partner, but he's also a mortgage broker, and he's done a lot of things. So let me go ahead and give him his props that he deserves, very well deserved. So Russell entered the commercial real estate finance industry over 10 years ago, where he started as a residential in the residential mortgage industry. This was 2002. And he excelled to become a top performer within his brokerage company. He brings a unique understanding of the industry and its constant changing risk and analysis to the table. That's going to be key tonight. With his comprehensive knowledge, he has been able to execute many complex transactions for ownership across the US. He's considered to be a top producer, 40 under 40, and he's built relationships with 50 plus commercial banks. So if you're looking for money, if you're looking for debt and even equity, he's the man that can get it. He can get it for you and find those that are providing it. Russell communicates directly with credit officers and top tier individuals within the banking industry. He spearheaded Cornerstone Capital of New York's expansion, and that's from New York to across multiple states, and he secured over $1 billion with a B in commercial financing transactions. His diverse experience and knowledge of the market has generated a wide list of resources and relationships for his company, Cornerstone, to secure financing for any commercial real estate transaction. Russell oversees day-to-day operations in the New York and Miami office. Not bad places to be. He takes pride in being able to delegate responsibilities to his team. So without further ado, Russell, I'm going to turn it over to you. I'm going to share the screen in case you want to share some slides, and we'll go from there.
All right, Ray, thank you very much for having me today. I appreciate it. Thank you guys for coming to the show and being committed to multifamily and commercial real estate. First, before I go into my spiel and we kind of just dive into everything into Cornerstone Capital and everything that's happening in the market, has anybody heard the phrase of what's happening now? Winter is coming, right? I'm assuming there are people that are afraid of what's happening in today's market, right? So if you're just starting out into real estate, this could all be way too much for you, meaning it's all coming at you very, very quickly, and you're not understanding what's really happening. But let me tell you that there are a lot of sponsors and owners that are in this business that are prospering more than ever during these times, right? And Ray has mentioned the most crucial things. Inflation is up by more than 8.6%, if I'm not mistaken, right now, right? So what does that equate to when you have inflation in the market? That means that things are going to get expensive. Yes, in theory, your groceries are going to get expensive. Your gas prices are going to get expensive. But guess what? Rent is also going to be expensive, right? So you get a chance to raise rents and really just base everything on inflation. Hey, it's not me, it's inflation. So there's a catch-22. You do have inflation, but your valuation and your appreciation in your real estate is also rising at the very same time, right? So now let's get into the rates, right? Everyone is seeing the Fed has definitely raised rates by an additional, 2 weeks ago was 0.75. They have estimated that the entire Fed rate of what they're trying to raise is roughly going to be about 3.5%. So by the end of the year, our rate is going to get increased by 3.5%. No matter where you're looking, if you're looking at the prime rate, if you're looking at SOFR, interest rates are up, right? So what do we do as operators, right? The most important thing, us as operators, we have to get operators as well as people who are looking for debt. We have to make sure that our underwriting is key, right? Got to make sure that we're underwriting our properties to a T. It's very important. Now, rates a few years back, right? If you're in the real estate industry, right? Operators who have been in this business, rates have been up to almost 20%, 12%, 15%. and it was just a regular day at the office. So the fact that your rate is going to get higher and it's going to be roughly within the 6% ranges in the next upcoming months is not really the end of the world. Operators that are smart and have been buying real estate for a very long time are actually going to be making a lot more money now than they've ever made. Why? Because sellers who are nervous and don't understand what to do with it now are going to be given discounts and haircuts, right? This is the time to buy. So this is what we do at Cornerstone Capital. We work with operators such as yourself, funds, private family offices, and we assist them with the financing once they go out and they secure a property. I'll dive into the different type of products that we have as a multifamily advisory firm. So I'll share some of my slides, but once again, if you guys have any questions or whatever it may be, just throw it out there. Even though I'm speaking, I think as we're going into the flow of things, unless Ray, you have something different, lined up. But if I'm speaking and you guys want to and you guys want to ask a question, I'd rather you do that. This way we're in the flow of things. So if you don't mind, give me a few, and I'm going to go ahead and share my screen right now as well. Can you see the screen right here?
Yes.
And it says Cornerstone Capital, correct?
Yes.
Okay, beautiful. Okay, so just a bit about who we are. I'm kind of just going to dive into who we are, right? And then we'll get into the multifamily and what it takes to really prosper during these times, right? That's the most important thing, understanding how to buy real estate during these times. So here we are, we're commercial debt and equity financing. Obviously, this on the next slide here is a little bit about who we are. And I think Ray just kind of went over everything into what it is. One of the most important things during these times is that in today's credit environment, each lender is different, right? Engaging in the wrong lender is awfully costly, and growing number of funding relationships, is often costly and time consuming. With an ever growing number of funding relationships across the credit and capital markets, right? Choosing the correct lender is crucial in the beginning, right? Because you only have a certain amount of time. So understanding the correct lender is very important. Here's a little bit about the asset classes that we kind of specialize in. Obviously, it's a mix, but one of the most important things that we do is the multifamily, right? So multifamily to us is very important. And I would say that about 60 to 70% of our portfolio is multifamily, along with our personal assets that we own as well as a partner. Obviously, during these times, the commercial loan programs, there are different types of programs during these times. And obviously, right now, Fannie and Freddie have raised rates. It's not the most convenient option as of right now, right? So there are different products for different scenarios, and we'll dive into that. But as you can see here, you have the different loan programs, such as conventional, all the way up to portfolio lending. You have your Fannie, Freddie, and Bridge, which are the most crucial ones. Here you have the relationships in a rising interest rate environment, right? So once again, when I spoke to you guys about relationship, I meant it. Relationship is very crucial during these times. Rates are going up, right? So banks are going to be underwriting to a certain stress test because they don't understand. So they obviously know the rates are going to be going up. So they have to underwrite a bit more stricter than they usually would, right? Investing financing is relationship based. When capital markets are volatile, relationships that are much essential in securing exceptions needed to accommodate loan priorities beyond an aggressive rate. When you're doing financing, right, and when you're approaching a lender, it's not just about the rate. It's not just about the rate. There are other things that come into it, especially during these times. And such are max leverage, right? You want to make sure that you get the max leverage for your business. But I will also go into how these operators are really using real estate right now to ensure that they're prospering during these times. I'll dive into it. But you also have longer fixed terms, right? You want to make sure that you do have a long term in order to outweigh whatever tsunami may come, right? Lower debt coverage ratio. These are just some of the things that we can go ahead and negotiate on behalf of the sponsors. And as you as operators, you want to make sure that you have the lowest debt coverage, because that equates to a higher loan amount. Reducing prepayment penalties and reducing bank origination fees. So that kind of goes into what it takes to really get the best products during these times, right? Here, I'll dive into a couple of other things, maybe 2 more slides. I won't get into all of that, and then we'll start talking about some other things. But factors affecting max leverage, right? So what are the factors that are affecting your leverage? When you put together a deal sheet and you put together an Excel model ready to submit to the bank, right? The red that you see in red are the things that we can't really factor, right? So we really can't, factor. Okay, so if you see here, guys, as I mentioned to you, the factors that are affecting max leverage, right? So whenever you guys are submitting your underwriting to the bank, there are a few things that we as advisor nor the bank can actually assume for, such as rents, right? We have the red here are the things that we can't control. Rents, no control over fair market rents. Expenses, right? Those are the things that we can control. As an operator, you can reduce your expenses by operating your property correctly, right? Amortization schedule. If it's 25-year, if it's 30-year AM, we can't control that. Your payment is based on that. DSCR and interest rate, 2 things that we can control as operators. These are all ideas that you can take on as operators when you're trying to submit an offer and you're trying to get a loan, right? Because effectively during these times, you are looking at an interest rate of about a 6.5 to 7% rate. So any kind of exceptions that you can receive from the bank is only positive for when you put together a deal for you and your partners. Next page, next slide. Do you guys see the slide? Okay, all right. So I'll dive into this, and then I'll kind of I'll stop here with my slides. But what I'll do is I can share this entire presentation so you guys can have it. But one of the things here is the critical consideration for investors, operators, syndicators in a rising interest rate environment, right? So avoid this scenario, right? As I talked to you earlier, every operator wants max leverage. What does max leverage mean? Max leverage means that you get to bring less money to the table. Yes, that's great, right? But when rates are rising, there are a couple of things that us as operators don't want to happen, right? Being over leveraged, right? You don't want to be over leveraged, right? Number 2, can't cover DSCR. Number 3, you can't refinance when you fulfilled your business plan. You can't do that. You can't pay off investors. Can't conclude the business plan. And the most important thing is that a lender calls on your loan. Now, how to operate is I've been speaking to many operators during these times when rates are starting to go up. Remember, it's not as cloudy as everybody thinks. This is the time to really go out and purchase properties because sellers are willing to make deals. I personally can speak from experience. I'm currently in a deal right now that we're partners with Ray, and we received $1.5 million reduction in price point. $1.5 million reduction in price point. And all we had to do was blame the market, right? The markets are up, the rates are up, and this is what we have to do. So that's effectively, what it is. So we got $1.5 million. We got $1.5 million. Sorry, give me a second.
Hey, Russell, I got a quick question from the audience here.
Yep.
You can go over to DSCR and what it is.
So that is a debt service coverage ratio. So it's the amount of monies that you receive from your property, divide that by the actual loan amount. So your monthly payment, your rent has to cover your income has to cover at least 1.25 times your loan amount. So if you're getting, let's say $100 a month in rent a month, it has to cover 1.25. So the bank really needs you to have $1.25. So it's 1.25 times your actual income that you're receiving. That's more or less the mathematics that the bank looks at it, right? So if you're not covering, that means that the bank, could effectively ask you to make sure that you reduce your expenses or start increasing rents and make sure that you're within that boundary. So as I was going back into it, guys, hopefully did I answer your question?
Yeah, that was great.
Okay.
Yes, thank you.
Sure, not a problem. So as I was mentioning to you guys right now, how operators are really getting ahead of what's happening in the market right now is that they're reducing their debt intake. They're reducing their LTC. So what's happening right now with all of these operators, they're actually not going for 80 LTC anymore. They're not going for the max leverage. They're reducing their debt intake to roughly about 65% of an LTC. What does that mean? Yes, you may have to raise more. You may have to get more equity to come into the deal. But by doing that, you're avoiding all of these scenarios that's on this page, right? You're making sure that you're covering your debt coverage. You're making sure that you're paying off your investors, right? You're making sure that you're concluding your business plan, right? And most importantly, you're not over leveraged if for whatever reason, the rates start going up again. And if you're taking a bridge loan, you're more or less going to have a floater, right? So what is a floater? It's based on either prime or SOFR. It's not a fixed rate. So if SOFR goes up, your rate goes up, right? So you want to make sure that you're covering in regards to debt coverage versus what the actual loan amount is. So these are just, some of the items that, you would want to avoid when looking at real estate at this very moment. If we were a year ago or anything else like that, it was the wild, wild west. Right now, more or less operators just need to be smart. But I most guarantee you that you're going to see more transactions per month or per year occurring now than it was a year ago. Because operators that are in this business understand what's happening and they're taking full advantage of everything. You're more or less, you're based off prime plus a certain spread. This is your standard bank or a credit agency or anything in that reach. So it's usually 20 or 25 or 30 year amortization, and loans typically take about 60 to 90 days. Here on the next slide is your agency loans, is effectively what everyone wanted to go, and that was for Fannie and Freddie loans. Nowadays, Fannie and Freddie has raised rates, and they require a certain property to be at least 90% or higher in occupancy. So if your property is not 90% or higher in occupancy, you will not qualify for a Fannie and Freddie loan. So just keep those, items in the back of your mind. And the next slide is where effectively every operator is looking to. When buying real estate in today's market, everyone is going for a bridge loan. Okay. A bridge loan is one of the most secure loans that you can get. There are a lot of other operators, and the individuals that run these bridge lenders, very smart individuals, and are in the real estate business and effectively a fund looking at opportunistic opportunities, right? They're looking for operators who understand the market, who are boots on the ground and understand a value add component. A bridge loan effectively is a value add component. You're buying a property, you're putting in some CapEx dollars, you're raising rents, you're either refining after that or you're selling the property. Those are the 4 steps: buy, rehab, increase rents, and refi. It's your standard BRRRR, right? So it's your standard buy, repeat, rehab, refinance, all of that. It's the same thing as you would have on the financing. On the residential properties. So that is it on this. More or less, you have a little bio on who I am and what we're capable of. The last kind of a few other slides I want to kind of show you guys is just more or less some of the recent deals that we've had. You have large multifamily properties in Brooklyn, in New York, and you have in Astoria, in Texas. So there's a wide range of properties that we can arrange financing for when it comes to multifamily. we don't necessarily follow state, we follow our borrowers. So if our borrowers and our partners and our colleagues are looking to buy in the state of Texas, we're going to follow them on that. Our relationship with our lenders, they'll follow our sponsors and they'll follow our operators when it comes to this. As mentioned, we're also on the operations side as well. So some of the properties that we've purchased, you have multifamily property. This property right here, it was 92 units in Jacksonville. This property right here was 136 units in Tallahassee, which Ray and his team are partners on. Here is a 92 unit in Riverdale, Georgia. Here was a shopping center in New Jersey. So we are pretty versatile. We understand the market. We understand what's what we're up against, and really how to progress forward. So I'm gonna go ahead and stop sharing here, guys. So I'm gonna stop sharing here, but I definitely want to open up the floor to any kind of questions or comments that anybody may have on here. I kind of went into a few things of who we are and what to expect in the next upcoming months. As mentioned, guys, get ready because rates are definitely going to go up. And you are, with that being said, you are gonna be seeing changes from the seller side.
Russell, can I start off with a question?
Please.
Can you speak a little bit to when you are getting financing, at what point in time you kind of lock in your rate prior to closing?
That's a very good question. So depending on what type of product you choose, right? So as mentioned, there are three types of products. There's the conventional, there's your standard Fannie and Freddie, and then there's your bridge. So let's say that you do want to lock in a rate. Say that you want to lock in the rate. You would choose the Fannie or the Freddie side. So what Fannie and Freddie does is that at the time of the term sheet, when you give your good faith deposit, they lock in your rate for 60 days. So you have 60 days to close on that transaction, inclusive of all the inspections, appraisal. Now that is up to Fannie and Freddie should they want to extend that past the 60 days. Same thing goes for the conventional route. Once you get a term sheet, you can lock in your rate with the bank. They don't change because it's their own funds, so they borrow a little bit differently. So once you get a term sheet, you lock in your rate for about 60 days. Now, when you get a bridge loan, unfortunately, there is no locking mechanism. You effectively have your prime or your SOFR plus the spread. Now, the bank will honor that unless, of course, the market shift and the Fed start to raise rates again. Then you'll have to just accustom to what the rates are at that very moment.
Okay, thank you.
Of course.
Hey, Russell, on that point, I know you just said, bridge loans don't really have a locked in rate. What I've heard on some loans is basically like a 2-point, I don't want to call it a spread, but a 2-point floater, if you will. Say that it's at 4%, give or take now, but there's a 2-point float on it. So it could go all the way up to 6% within that time. So it's not locked in, but there's at least a range locked in. Is that an accurate representation? If not, could you clear it up for me, please?
Absolutely, yeah. So you are saying the right things. There is a cap onto where the rates will actually jump. And the reason that the banks do that is because obviously no one wants to give you a loan that's going to turn into 15 or 20%, because then you won't be able to service the debt. So what they do is they usually, like you mentioned, they usually have a cap of about 2 to 3% over what the rate is. And how they protect their hedge on that is that they require you to buy what is known as a rate cap. It's a rate cap purchase. So what happens is if that rate cap goes over that cap, the insurance companies will then pay for it. So the bank is protected and you're protected. And this is why I keep telling you guys is that real estate will only get more. You'll see more transactions happening because you're buying these rate caps and you don't really care what's going to happen in the market, right? If you're looking at an asset, the rates go up, you're protected with the rate cap. So if it goes over a certain amount and your strike price, which is what you're buying at, goes higher than what it is, the insurance companies are covering that difference.
No, that makes sense. And so I think the key there for everybody is to be stress testing your underwriting at that highest possible rate so that you'll make money, no matter what. I mean,
Smart. And you can run it in your model and you can see the difference of what it'd be. Will it go up to that? Nobody knows, but it's a very good thought just to see if it would.
I'm going to ask one follow-up question. Is it fairly standard that you buy a rate cap when you're looking at bridge loans?
Nowadays,
or
yes.
in this environment, yes, it should be standard.
That is correct. It was my first rate cap that I was required to buy, which was in April of 2021. It was the first rate cap. April 2021. It was during COVID, where we didn't understand. Everything was shut down. It was from 20 to 21. The bank required us to buy a rate cap. I didn't understand what it was, but they explained to us, right, for the first time that we were hedging against rising rates. If something were to happen, if the economy, would have stopped, if we would have had another Corona incident, right? It protects us in the event that, rates start to rise, the stock market goes down, and we are protected. So as of right now, yes, every bridge loan is more or less going to require you to buy a rate cap.
And how much does that typically cost?
So it's a bit expensive now because it's based on the swap. It's based on what the markets are. I mean, you are looking at about a 7.5% rate. If you're going into a deal right now, into a bridge loan, you should anticipate anywhere from 6.5 to 7.5%. So I'm just estimating. Say you're getting a $10 million loan, you're paying $250,000 for it right now. So, and that is an estimation, and I'm not. It's not a concrete number, but I give you an example. When we purchased our Tallahassee deal for $18 million, we paid $175 for it
For the rate cap.
Back in 2021. And now that the rates are up, I get the reports every month. That rate cap is $550,000 now. So there is a difference between that. So once again, you plug it into your model, right? Just like any other expenses, you have to pay broker fees, you have to pay for other expenses, you have to pay for equity fees. You plug and play. You put that into your model, and more of the times, it's going to work. It's just the cost of doing business. It's another check off that you have to do when you're buying multifamily properties. But don't forget, you have higher expenses here, but you're getting a reduction in price point. I almost guarantee you guys that if you're getting into a deal right now, or you're trying to maneuver, or you're trying to do something, and you go back to the seller and you say, guys, I'm sorry. I know I'm in contract and I hate doing this, but I need a reduction in price point because of the rates. I'm almost certain that you would get something in return, or you would get something in what actually beneficial from the seller, in my opinion.
Hey, Russell, this is Winston. I got a quick question. With the current climate, do you foresee any change in the lender reserves?
And that's a very good question. As of right now, lenders are requiring about 12 months of reserves, right? And it depends. I've had a scenario where our property is 95% occupied and the bank wanted 6 months, right? They wanted 6 months, and that was minimum. But, you went back and said, hey, why? You're at 95% occupied. Nobody knows what's going to happen. They want to make sure that you're protected. I would estimate at this very time, just plug in for about 12 months of reserves.
Thank you.
I think Ray is frozen.
I can hear though. Everything is
Oh,
good. I appreciate it.
beautiful.
Yeah, I definitely did freeze. I didn't want to close this out, but quick question for you, Russell. So we've talked a lot about buyer side. Talk to me a little bit about seller side and your if you're in a deal right now that you're trying to sell and, you have some considerations and some decisions that you have to make, what are the main factors that are really driving, your pricing? And I'm thinking more along the lines of yield. Talk a little bit maybe about the yield and those sort of things that also kind of play in that side of the house on the seller side.
Yeah, so that's a very good question, guys. And just don't forget that sellers also have mortgages, right? So sellers also take exactly what we just discussed. 3 types of loans: conventional, Fannie or Freddie, or bridge, right? So they're in the same position as you are when you're going and get a mortgage. So they're probably in a bridge loan, putting their business plan together, and they're getting hit with these high interest rates, right? It's time to come out, and they're in a position where, like, okay, what do we do? Our rates are going up. My cash flow is not in place. I need to get out. So for what they're looking to get right now, and they're trying to sell and they're trying to max out during inflation, may not always be the best case scenario for them. So this is how I go back to the fact that sellers at this very moment are if they're a real seller, they're looking to get out of it as well. They're not looking to give it away, but they are reducing price points to get out of what they're in, especially if they're in a bridge loan that's coming due, right? So speaking from personal experience, last year when we sold the property, we were in a great position. Rates were exactly where we needed to be. We sold it with almost a 3 times multiple, right? So, and that's when the market was great. We were all very happy. Nowadays, I'll be happy, if I can offer a 1.8 times multiple, right? A 1.7 multiple, because we have to understand that we're in a market where it's different than what it was. So sellers right now are looking at assets right now and saying, okay, my loans are coming due. What do I do? How do I get out? Perfect example of what's happening right now with our deal. Our seller is in other deals right now, and he has deposits all over the place. He has his own loan that's coming due. His equity guys are knocking on his door saying, hey, you promised us X with all this interest rates. Your payments are going up. Your expenses are going up. Let's get rid of this property. So transactions are going to happen.
And I know from the investor side of the house, of course, the investors are looking at this, like you mentioned, and they're wanting to get the biggest return on their money. But I think what people forget is there is no place for an investor to put their money right now that's going to hedge. First of all, against inflation, and second, everything's going up. So where stocks are down, bonds are becoming an issue. Where do you put your money? I mean, I think all being equal, I think real estate is still going to be the driving factor because it does hedge inflation, and you're able to, with these 12-month leases or even shorter sometimes, you can reset that rental point to continue to get those higher incomes to match that debt and that extra interest, those extra costs, those expenses. And I think people forget that. I've had several investors that are like, listen, I get it. Things are tight, but what else do I do with my money? I said, you're right. What else do you do? I mean, you just got to write it out. This is real estate is one of those things. You just invest and wait, not the other way around. Invest and wait. Now, these longer term holds, which we're in, is really how you're able to kind of hit these little blips and come right out of them. The other thing I think is important is supply. Supply has not changed. The Fed can do whatever the Fed tries to do, but they can't change how many houses are being built. They can't change where the lumber is. There's a deficit, and it's going to continue to be a deficit, and that's going to continue to work in our favor, especially as rates go up and single family gets unattainable. People are going to have to look to rent.
100%, Ray. And I'll be the first to say, please, guys, don't leave your money in the bank account. You're earning less than 0.1% right now with inflation, right? You have 100,000 with inflation. You're at 82,000, right? You're losing money by keeping it in the bank. No matter what you do, please don't keep it in banks. Obviously, I forgot the last time I looked at my stock portfolio, because every time I look, I turn red. Because I mean, with all due respect, I mean, I'm losing 40 to 50%. I'm already down to 50%, and these are large stocks, right? So what better way to really make your money work for you than real estate? I'll be the first to say that I probably 90% of my portfolio is in real estate. And like Ray said, invest and wait, because real estate is the #1 appreciating asset in the market, right? Appreciation, market rent, you have job growth, you have population growth. All of that right there is increases in the value of your property, right? So if you're investing smart and with smart individuals such as Ray and his team, you're definitely going to prosper, because choosing the right market is very, very important because of all of these other factors that I've just mentioned.
I'll ask a perspective question, just to get your perspective, Russell. So we know historically in recession, rents tend to, obviously changes by market, but in general, remain flat or continue to grow in recessions. As we think about going into this potential, well, I think we know we're going into a recession, right? What are your thoughts on rents and just the real estate market as a whole? You can divvy out single family and multifamily separately. Just kind of what's your perspective?
And that's a good question also, Kelly. I'd like to say that rents, depending in a certain market, you're definitely going to see, rents flat a bit, right? It's just, it has to happen. But the key here is operations, right? So even if your rents kind of flat out and you can't increase rents to where the market is, you're still hitting the 3% increase, right? You still have your market growth. But what you don't have is operations. If you're running your operations the correct way and you're keeping your expense level to where it needs to be, you can outweather any kind of flatness in the market, right? So if you're now raising rents, you're reducing your expenses, right? You're really tightening your operations. You're not fulfilling your entire business plan as you wanted to because of things of that nature. So you have to really understand where you are. I think the markets are definitely going to play a big role. Tertiary markets are definitely going to get affected a bit more than that because other things will affect it, especially if you're in a city where there's only one type of job growth, such as, for example, oil, right? Or colleges, for example. If you're like in just one type of job, you are going to get affected by that. But once again, if you're running the property correctly, say under a 30% expense ratio, let's just say, then I think you'll be okay.
Russell, I got a question for you. In this market, what would you say is the best asset class, I guess, type of property that an operator can get into right now? When you talk about A, B, and C class, and maybe even D class, I guess some people are looking there.
I mean, I would always say multifamily. If you're referring to what type of assets, such as retail, shopping centers, for me, it's multifamily and then shopping centers, right? So for me, multifamily is invest and wait, right? Invest and wait. Shopping centers are a bit different. It's cash flowing enormously from day one, but it starts to decrease as time goes on, right? So it's a bit different than what it is. For me, multifamily, a large portion of my portfolio is in multifamily. It's going to be multifamily because I'm extremely bullish on the appreciation that multifamily has, right? So if you have other operators that are building around your area, such as construction projects, guess what? Your rents are going up, right? So if somebody is going to be building a Class A multifamily property and you have a Class C property that you're turning into a B property, guess what? You won't be too far from that Class A rent because you're right there. You're within that vicinity. So if they're charging $2,100, I mean, guess what? You'll be charging $1,900. So effectively, in my opinion, multifamily will always be one of the most favorable assets for me and my team as of right now.
And just to be a little more specific on your multifamily, between your Class A and C, where would you most rather invest? You mentioned C, if you can reposition, but I think I'm not going to lead you to what I'm thinking,
Yeah.
but it's just interested in your perspective.
Yeah, absolutely. Listen, for me, it's always a class C property, right? A C to a B, right? I kind of want to do the work, the value add, because while you're doing the value add, you're growing appreciation, right? Your internal rate of return is higher, right? Your equity multiple is higher than that, right? On a class C property. When you're purchasing a class A, it's safe, but that's what it is. It's just safe. So your cash on cash is always going to be 6 to 7%, maybe something within reach. Yes, of course, it's better than leaving in the bank account, but why do a class A when you could do a class C and earn 18 to 22% IAR on your money, cash on cash, at least a 15% plus, right? Because you're creating the value. Class A, all the juice have been eaten. So it's just more or less just sit back and collect. So if you ask me, I'd go for a class C any day. C to a B, of course.
So a C plus.
C plus, I'll take that.
Yeah, no, my thought is, right, if, as you get into the higher rents, your C class, your workforce housing gets harder to bump rents. But in the B class or the C plus to B, you have a little bit more price flexibility, and there's a little bit more upside on riding that higher rent, because essentially you do have some higher income, some professional folks that are living there. They just want to rent, and but there's some money there, and they can go up a little bit more. You can hit a bump, kind of a ceiling on the C class if you stay in a C class that you buy it as a C class, and it's not ever going to be anything but, right. You're going to hit that workforce housing ceiling, if you will.
Oh yeah, and one thing I just wanted to pinpoint as well, as you said, we purchased a C plus. We purchased a C plus property in Jacksonville, a C plus, which we turned into, let's say, a B minus property. Our rents went from $885 to $1,400 in 4 months, and simply because we wanted to raise rents, we did the exterior renovation, we did the interior renovation on the units, and we tested the market. People just simply wanted to pay the rent. They didn't give us any pushback, right? And that's effectively why we love the B plus, because we just created the appreciation. We've just created the rents. So you're talking about a 4 month, and we were able to bump up rents by almost 70%.
One last one, Russell. Are you seeing essentially when you're going into contracts, are you seeing finance contingencies put in place? I understand now that hard money's kind of gone away a little bit. That's one. What about finance contingencies?
So I haven't seen anything like this right now. I haven't seen sellers actually bend to that point of view. In the last few months, I haven't seen any sellers give any kind of financing contingencies when it comes to multifamily. Could things change as we progress? Yes. I've seen people are getting more aggressive, hard money from day one, but getting the reductions that they need. But I do believe that it would be a good option if somebody really wants to sell the property, then they would throw in a financing contingency to the right operator, of course, right? Because no seller really wants to wait 60 to 90 days and really ruin that for themselves.
All right, I think we've hit it. Russell, if you want to just tell people where they can find you, your website, your email, whatever you want to give, and then it's great partnering with you. We're looking forward to partnering on some more deals, and it's always good to have an insider perspective. And those are the best partners.
I appreciate that, Ray. Thank you very much for having me, guys. I'll reach out. I'll put it into the chat room, guys. And what I'll do is I'll email you the deck, or actually, Ray, you can go ahead and just email it to your team if they want to just reach out. But our website is csg-ny.com. That's www.csg-ny.com. And you could find out all the information on the financing there on that website. It'll be all of our agents, advisors, credit officers, credit managers, analysts are on there. So if you guys have any questions or comments, I'll be more than happy to size anything up for you guys, answer any of your questions. Our team is readily available to ensure that you guys succeed and we all do well during these times.
Thank you, everybody, for joining us today. I will go ahead And like I do with these, I'll go ahead and save it to my YouTube channel. I'll send that out, and then I'll, we'll advertise it and blast it, and just look at this thing, and maybe, reevaluate where we are 3 months from now, and maybe to bring you back on the show as things change, Russell, or maybe just a guest blog or something, because I know that in these times, the most important thing is to stay on top of the market, understand, don't give in to the fear. I think, Warren Buffett says it best when, and I'm paraphrasing here, but, when people aren't investing, that's when you should be investing. It's the same thing. Everyone, there's this people they start they get paralyzed. They're like, oh my God, I can't do anything with my money, when they're actually hurting themselves. So it'll be fun. It'll be interesting. It's a good ride. It's definitely a time to be active, not passive in this market.
Oh yeah. And you are absolutely right. What's great. Being active right now will go a long way, guys. Mark my words. You're going to see a lot of transactions happening in the next 6 months. Tons of transactions. Even though you hear what you hear from the feds, if you're an operator and you want to do well in this market, it's going to be the time.
All right. Well, thanks, Russell. It's been great to have you. And like always, everyone, invest where it makes sense. Have a good night.
Good night.
All right, guys. All the best to you guys. Ciao.
Take
Have a
care.
good night.
Bye.